Thanks so much for joining us at Investing City. We're happy you're here. In this series, we're going through some Investing 101 questions that my fiance and some of her friends had. And to really get the full picture and really the full experience, please watch all the videos in this series, and I'm sure you'll come away with a lot of knowledge about investing. By the time you see this, I might be married to this woman. I also might not be.
If Corona has anything to do with it.
Bye. Okay, I think that's good. Do you think investing in oil is a good idea?
So I'm definitely not a big believer in oil stocks or any real commodities. So I personally, there's something called a circle of competence, and it's basically things that you know really well, and that is just not within my circle of competence, and so I kind of stay away from it. So if you have some sort of edge, you really know a ton about oil, then I'd say go for it. But basically, trying to predict the price of a commodity is very difficult. You have to know the supply and demand imbalances like the back of your hand, and I'd say it's way more risk because you have to know what you're doing.
What is your opinion on risk and how much you should take when investing?
Yeah, so risk is a really interesting concept because a lot of people talk about risk as stocks going up and down a lot. But the thing is, if you're looking out 10 years, if it goes up and down a lot, but still goes up and to the right, then it's probably a good investment. You don't have to worry about all those minor fluctuations. So risk is really, I think the definition is permanent loss of your money. I think that's really what we're talking about when you think of risk. And so kind of going off of that, you should never invest anything that you absolutely need. So only invest money that you are willing 100% to lose, because then that frees you up from that when the stock market crashes and all of a sudden you need the money to pay off some bills. It will be a terrible time to take that money out. So only invest money that you are absolutely willing to lose and that you just don't need within the next at least 5 years.
That's good. What is the difference between Roth IRA and a 401k?
Yeah, sure. So 401k is only offered by an employer. So if you work for a company, they'll probably talk about how they might match your 401k. And so if you invest, let's say $10,000 in your 401k, they might match the first 4% of that. So that would be $400. So $400 free dollars. And so that's a great idea.
And that's a retirement.
Exactly, it's a retirement account. So 401k is essentially the government's code for a employer-offered retirement account. And so Roth IRA, Roth Individual Retirement Account, that's what IRA stands for, is a personal retirement account where you don't actually, it doesn't need to be offered by an employer. And there's a lot of differences between the two, like contribution limits. You can contribute way more, $19,000 to a 401k versus $6,000 in an IRA or Roth IRA. And then the other thing, there's like a bunch of differences, but the other thing is Roth IRA is after-tax dollars and 401k is pre-tax dollars. So let's say you're making 50 grand and you contribute 10 grand to a 401k. So instead of getting taxed on the $50,000, you would now get taxed on $40,000. Basically takes your basis down because it's pre-tax. On the other hand, if you're contributing $6,000 to a Roth IRA, you would get taxed on the 50, but then you would contribute the leftovers to the Roth IRA account. So there's kind of differences, but basically the gist is that they're retirement accounts that allow you tax advantages for the long term.
Got it. And if you work for an employer and you have a 401k, can you still get a Roth IRA?
Yes, it can.
Okay. Would you recommend people do that?
Yeah, so there's kind of like a good sequence to go through in terms of like, once you're making money, do this, then this, and then this. So first of all, I think it's a great idea to contribute as much as you can to 401k, at least to get the match. So, because that's free money, right? And so that's a great idea. But the thing is, maybe you can't contribute the full amount, which is $19,000. A lot of people, it just doesn't make sense for them. So try to get as much free money as you can. But besides that, it probably makes sense to pay down debt because there's interest rate coming out of that. And you just don't want to have too much debt. That's just a great thing. So yeah, there's a lot of sort of things that make sense to do, like just having an emergency fund where you have at least 3 to 6 months of savings. So just a few things like that.
And then if you have the leftovers, start putting it in your retirement.
Yeah, exactly.
Accounts. Got it. I like that you know all this stuff for my own benefit. How do you choose where to put your money and how to split it all up?
So how do you choose where to put your money and how to split it all up?
Yeah, I guess what they mean is, how many shares do you buy, and how do you decide to buy this many shares in this stock versus this many shares in another stock?
Yeah, that's actually really difficult. So it's something called portfolio management. It's basically how do you split up your money? And I think there's 2 different things to talk about. One, there's different asset classes, and then 2, there's different stocks or different assets or different things within asset classes. So for instance, let's talk about stocks as an asset class. You would pick individual stocks within your stock portfolio, and then there's a bond asset class. You could pick different bonds within that asset class, and there's money markets, and there's real estate. So different asset classes, you have to get that figured out. And so if you're young, it really makes sense to be all in stocks. Bonds provide cash, actual coupons that you will get over time, but there's really no growth in that, and bonds statistically have returned much lower than stocks over time. Even real estate has. So for me, I try to keep a nice cash buffer where I don't need to worry about expenses, and then put the rest in stocks. And so that's my choice of asset class because I think there's the most potential for growth. And if you look the past 200 years, that has been statistically backed up. So, okay, now that we have the asset class, how do we split up our money between stocks? So now that is pretty difficult, and it really depends on kind of your conviction in the business, like how certain are you that it's going to be more valuable in the future? And so you'll place a higher value on that. And I'd say you probably want at least 10 stocks in your portfolio to give you a decent amount of diversification. Some people won't think that's nearly enough, but statistically, once again, the incremental benefit from going from 10 to 25 stocks is not actually that much more diversification. And if you're holding 50 to 100 stocks, you might as well just buy the index fund because it's a similar return profile, essentially. So I'd say 10 stocks is a great place